right, so why don't we go ahead and get going? Good morning or good afternoon, depending on your location. Welcome to the Q3 WebEx. Excited for you to join us. As a reminder, our compliance and legal professionals couldn't be here, but they sent their regards. Today, you've got myself, Brad Long, Managing Partner and Chief Investment Officer at Fiducian Advisors, and Rob Lowry, Principal and Associate Research Director, with a specialty in our fixed income space. So we'll get into that more in a moment. We have a lot to cover and a little bit of time to cover it. We've got 30 minutes and we want to be respectful of your time. We will pause briefly and just help enumerate where we are in kind of the life cycle of our investing. As a reminder for many of our clients that know, on an annual basis, we look at our forward-looking capital market assumptions and expectations. We will then go through a process where we'll rebalance portfolios, optimizing to what we think are the best forward returns and minimizing what we think are the most relevant or apparent risks. So we're kind of knocking on the door of that. We'll start rerunning that data as of the end of this month. Our investment committee and research teams will meet intensively over the month of November, and you'll see our 2026 outlook coming out in December. So we may hold some punches, if you will, on 2026 outlook on this call. So if you have questions there, we appreciate as we start to gaze towards the end of the year that may naturally come up and we can hit some of it, but just to give you some sense of where we are in process. So most of our conversation today will be focused on Q3. The next time you hear from us, we'll really be talking about 2026 and beyond and opportunities going forward in markets. So with that, remember, you can put questions in the chat queue. We'll try to answer them along the way, given the short amount of time. But if we don't get to them, we'll get to them at the end, or you can always reach out to your advisor or one of us. We're happy to address them after. All right, Rob, so with the focus on Q3, why don't we jump in and take a look at what markets have provided over the last handful of months?
All right, let's get into it. We'll go left to right across the page here for ease of reading. Markets were really strong across the board. Fixed income positive, equities positive, and diversifying segments positive. Interest rates fell in the quarter, so really helping fixed income. Core bonds were up about 2%. Longer duration assets, so those more sensitive to interest rates, up about 3.2%. The key drivers there, right? The Fed cut, so that drove rates lower on the short end of the curve. And then on the long end of the curve, rates fell as well. A little bit of concerns about the budget deficit, the looming government shutdown, which we've now entered, and just a little bit of declining labor market conditions. The standouts for the quarter, though, U.S. small cap, emerging market equities. U.S. small cap up double digits, same with EM. Ahead of U.S. large cap, so a nice shift from earlier in the year. And then we continue to see a standout performance for our international markets, international developed and EM, ahead of U.S. domestic markets. Well, we can touch on that in a little bit. Commodities had a nice performance as well for the quarter, up about mid-single digits, 3.5%. A big standout driving that performance was precious metals, in particular gold.
So why don't we land on gold for a moment? It's certainly in headlines. We want to address it very quickly. Obviously, it's not a common asset held amongst our clients or in portfolios. Gold is one of those assets that's often thought of or utilized in portfolios as a hedging asset. Either people are worried about inflation, they're worried about downside risk. And in today's market, you can easily attach yourself to a number of worries. One could be debt and deficits. We'll talk about those and tariffs in a little bit, and economic policy. The other could be just the potential for downside risk. We hear about how markets are at all-time highs quite frequently. Today, crypto is an independent asset that's not reliant upon the debt or deficits, but obviously it carries a lot of volatility, so it might violate that principle of kind of principal protection, which people rely on gold. And then a weaker U.S. dollar as of late have made treasuries a less attractive hedged asset for U.S. investors and non-U.S. investors in particular. So gold has been one of those assets where they have come into. We would still say gold tends to be a fickle friend, right? It's not great at hedging downside risk. It's not great at hedging long-term real return. And we're happy to engage in those discussions should you have more questions around them. But we didn't want to leave it out. It's one of those things that's leading in headlines. We want to make sure to address it here, just in case it happens to be on the top of your mind.
Let's take a little deeper look at the international outperformance. We touched on it in our mid-year outlook as well, but not surprisingly, the dollar has been a big contributor to that. It's down about 10% year to date, but it's not the only story. Local market performance has been really strong as well across regions. So both the dollar tailwind plus strong performance in local markets have helped international year to date. If we jump forward one, Brad, and it's not just one region, right? It's not just emerging markets. It's across regions. China has had a really strong year. AI enthusiasm around Tencent and Alibaba has contributed to that. Investor optimism around government policy as well. And Europe has been strong too. Germany, UK, Italy, all outperforming the US on both a local and dollar basis.
So, Rob just mentioned government. So why don't we hit another headline? Unfortunately, I think this quarter I got stuck with some of the headline news. One of the headlines out there is government shutdown, right? So, currently the government is shut down. This is quite literally a screenshot from the Bureau of Economic Analysis. That's a government-sponsored agency. They're responsible for reporting some of the economic variables that we'll report to you or you may read on your own or in the Wall Street Journal. They're closed for business right now. We're on our ninth day of government shutdown. And so we want to provide a little bit of context just behind, what does it mean behind an economic impact and market impact around government shutdowns and how we should think about that in portfolio construction. First and foremost, this is not, unfortunately, this is not the first rodeo with a government shutdown. This has been around since, well before Donald Trump 1.0 or Biden, dating back to the Ford administration. If you look at just a straight average of previous times in which, the purse string holders in the legislature were unable to come to resolution and maintain, operating governments, it's around 8 days. So we're at +1, right? I think we're in the ninth day of the government shutdown. So we're a little above average here. Now, as we mentioned on the previous page, right, there are a number of impacts that come from this. We're narrowing our focus just to financial markets, but there are certainly many others. And, we've gone dark on some data. It's not all data, not all economic and markets, specifically market data, do investors rely on the federal government for, but some of it we do, and many of which you'll see non-farm payrolls, which come out weekly. You'll see, the inflation figures that come out. Those are big ticket items. We've already started to, tick past some of those and miss some of them. And there are a number that are coming up. October 15th is CPI. The Consumer Price Index is a big item that markets have been trading off, trying to understand where the Fed is balancing potential weakness in labor, which Rob will get into in a little bit, and the tailwinds of potential inflation, mostly mechanically, perhaps coming from tariffs as they're just starting to hit balance sheets of businesses and individuals, which we'll talk about in a moment. Now, interestingly enough, I don't want to make a comment on the role of federal government and the success of markets. I'll leave that to my libertarian colleagues. But as we look back over time, it's a bit of mixed results. Oftentimes, markets are not favorable of a closed federal government, knowing that it serves primary important purposes in the functioning of the economy and markets. But it's not an environment, and you do see some positive on the screen here, the last and longest period of time of closure. Actually, we had the strongest positive returns. So this isn't a new trick for the federal government. It's also not a new input for markets. And frankly, what often happens is there is a delay in economic growth that tends to be then pulled forward after in the next quarter, next month. So the market impact tends to be fairly benign. Hopefully we get quick resolution. Ultimately, disagreement around the extension of ACA and other funding arrangements should hopefully be resolved over the coming days, maybe weeks. But we don't think that this is something that necessarily requires action in portfolios or rebalancing. Now, while staying on the tone of federal government and impacts, 2 quarters ago, when Rob and I were sitting in front of you talking about, the Rose Garden and a big piece of cardboard and the number of tariffs that were just raised across the board for reciprocal tariffs for countries around the world, tariffs was the only word it feels like everyone wanted to talk about. Now the tariffs are actually starting to make an impact in the market to consumers, right, as they're being implemented, and those prices are then flowing through to companies and to ultimately consumers, you and I and others, of goods around the country. Tariffs have kind of fallen to the back seat, right? There's still a headline, and it's mostly around the incremental changes in tariffs or resolution, meaning an ultimate rate is decided on. But funny enough, now is when tariffs are actually making an economic impact. Today, as we look at the level of tariffs and the geographical distribution of tariffs, it's starting to impact businesses. So quite simply, if you think about a business that manufactures something and sells something to us as consumers, the way many businesses handled the potential of tariffs was they front loaded and bought a lot of inventory in the first quarter. As that inventory has now effectively rolled off, right? So the less expensive inventory, pre-tariff inventory, and we get into a higher consumption season, right? Around the holiday season, businesses and consumers are going to have to make some decisions. Businesses will have to figure out how much of that they eat, right? The higher cost of goods, and how much they pass on. The pass on will come to us as inflation, right? It might be a mechanical move up in inflation, and we wouldn't be surprised to see that show up in CPI and other figures over the coming months. Or if they decide to eat it as a business, that would come through with lower profit margins, all else equal. Both of those are important to long-term market outcomes, but mechanically, it might end up being somewhat of a stair-step move in inflation. But to use maybe a dirty word or a scary word from an economic perspective, it might end up being transitory. We'll have to watch that closely. It's obviously going to be a big part of our conversations for 2026 and outlook. But we can say we positioned what we believe the portfolio is well ahead of what these impacts could be. And Rob mentioned on our outlook, right, on previous pages, allocations to tips, allocations to unconstrained fixed income, areas of the market that are highly sensitive to inflation have obviously benefited from that year to date. So more to come on tariffs and the actual impact rather than the conversation as they're flowing through when we get to fourth quarter, which is a high consumption season. But for now, keeping a close eye.
Let's talk a little bit more about the labor market and those shifting dynamics there. We've mentioned it a few times already on the call today. You can see on the left, non-farm payroll has steadily declined over the last year on a 3-month moving average. And unemployment rate, while the scale on the chart shows it really spiking, if you look about the last 12 months, it's kind of remained flat, I'd say, between that 4 and 4.3 range with a little tick up at the end. But it's been an interesting market where there hasn't been a lot of hiring and there actually hasn't been a lot of firing. Small businesses fell, small business jobs declined by about 40,000 over the last month. But on the flip side, large businesses added about 35,000. So a pretty neutral dynamic there. See job openings versus the number of unemployed has come, and it's kind of in that 1-to-1 ratio now. If you look back 3 years ago, it was in that 2-to-1 ratio. So a lot more opportunities for people to get jobs. But if we think about the overall market here, immigration policy can have a pretty big impact, and it can keep a lid on the unemployment rate going higher. The economist from the St. Louis Fed did a study earlier in the year, April timeframe, that break-even rate to maintain unemployment, kind of stable unemployment, about 150,000 jobs needed to be added per month. With the new policies being put in place on the immigration side and people coming out of the labor force, that break-even rate has shifted a lot lower, estimates between 32 and 80,000. So yes, the month-over-month change has declined, but other shifting dynamics in the market have maybe lessened that impact. Now, all that said, it has been a shifting dynamic and forwards lower. It gave the Fed room to cut rates in the third quarter in September. So the Fed cut by 25 basis points at the September meeting, the first time since last December, so a 9-month pause. Now, to put that in context, where you can see historical previous cut cycles on the page here, a pause isn't rare, and it's not out of the question. If we think about pauses during cycles that are 5 months, or a pause that is 5 months or longer, the average pause is actually 10 months. So our pause this cycle has been right about average.
So to that end, right, the big question in markets is where is the Fed going? And I mean, that is the big bet, right, that's out there. The path is important, right? So ultimately, when does the Fed lower rates? How much do they lower in rates? Rather than trying to nitpick the exact path, right? Because that's effectively a bet, right? Will it be October? Will it be November? Will the Fed cut by 25 in December? Nobody knows. There are betting odds associated with that. You can take positions in that. Ultimately, timing interest rates we think is somewhat of a losing or failed errand, if you will. So let's, instead of trying to figure out the precise path in which the Fed will be moving, let's talk about ultimately where they're going, right? So not what road are they going to take, but what is the destination that they're trying to get to? Now, the Fed is seeking ultimately, right, with a benign inflationary environment and full or close to full employment, which is Rob mentioned at 4.5, 4.6%, that would be considered full. They want a neutral rate. So the economic equivalent of their foot is not on the economic brake pedal and their foot is not on the economic gas pedal. Today, right, they have their foot slightly on the economic brake pedal, right? They have rates that are above a rate of inflation such that they are seeking to slow the economy because the primary concern until late has been inflation. Now, last month, shifting job and labor information allowed them to release a little bit of the brake pedal, but ultimately they're trying to get to this point, which is called R star. And in an academic term, that's the neutral rate. Now, in theory, R star would be something like this. Inflation is 2%, which is the Fed's target. And historically, a 1% real rate above that, so 3%, would be R star. That would be not on the gas, not on the brake. And that allows the economy to hum along where they don't have to be accommodative because things are weakening and they don't have to put their foot on the economic brake pedal because inflation is rising. Now, a target of 2% inflation, I think, is going to be difficult to achieve. We've talked about that for a handful of years for structural and other reasons, some of which are just sitting in front of us today, right? We talked about tariffs and their potential impact. So long-term secular, in theory, academic theory would be about 3% or 1% real. Reality is that in this environment, inflation is likely going to be above 2%. And the neutral rate could be thereabouts around 1%, which means that we do have some more room to cut here. Now, will it be, October, December, January, March? We don't know. No one knows. But we do think that generally the path is lower as the Fed seeks to get back towards the neutral rate. 3 is too accommodative, likely, in the inflationary environment that we're in. But sitting at 4 and 4.25, which is the current Fed target rate, we do think that there is some room to move lower. So call it to that 3.5 level if inflation is between 2.5 or 3%. So we don't know the exact path that we're on, but we do know generally the destination, which allows us to position what we think thoughtfully ahead of that. And that is obviously what we have done coming into year to date. And it's a big conversation on the go forward for 2026 and our outlook and beyond.
Let's take a quick look at small cap. We've talked about it as a standout for the quarter, up 12.5%, maybe 400-ish ahead of the bench of the S&P. A large driver of that was the optimism around the Fed rate cut and the optimism in markets for and expectations for future rate cuts, as Brad just alluded to. If we think about small cap compared to large cap, they tend to be higher leverage companies, higher interest costs, et cetera. So you can see, right, leverage, debt to EBITDA, 3.3 times for the Russell 2000 versus 1.7 times. Just that interest expense as a percent of total debt, much higher, not quite double, but much higher than the S&P 500. So, which had been a headwind for small cap, right? As interest rates rose, that was a headwind for the asset class over the last few years. But as we look forward, it could be an opportunity and was one of the reasons for the optimism and strong performance in Q3, right? Small cap stands to benefit a little bit more than large cap should interest rates come down. It's not the only story, though. The outlook for earnings has shifted too. S&P 500 earnings have been really strong. AI optimism, the concentration in the index driving some of that as well. But shifting dynamics in the market, lower interest rates, more accommodative policies coming out of Washington for business, deregulation, et cetera, clarity and outlook on tariffs. That's really shifted the dynamic and the expectations for small cap stocks. So as measured by the S&P 600 here, a really big shift looking into 2026. About a 25% quarterly average earnings growth compared to 17% for the S&P 500. So the combination of the lower interest rates and greater expectations for earnings growth helped drive small cap for the quarter and gives us some optimism going forward.
Now while we're on the large versus small cap question, let's go back to our friends in large cap. Today, right, we saw a decline in large caps coming through April as markets almost dipped into bear territory. What's old is new. They're back to their highest levels of concentration today. The top 10 in the S&P 500 account for around 40% of the market cap. That's an unprecedented figure. That's higher than it was in the tech bubble. It's higher than it was in previous markets. And so a large percentage of the overall index is really dictated by a small percentage of the total stocks, 10 of the slightly over 500. Now, it's not because the prices are super high, but they are undeserving, right? That could be argued the tech bubble period. These top 10 stocks account for almost a third of the earnings of the S&P 500. So, hey, have gotten there because of success and because of optimism. Microsoft makes a lot of money and they're a top 10 stock. And so they have a very large weight. Now, you can see that the percentage of the market cap is slightly above what they actually earn, right? So the optimism is indicated that they will continue on that trajectory. We talked about concentrated consequences and the impact of that and fragility in markets in our 2025 outlook. And that still holds today, right? While it is a diversified index, it is highly reliant upon a handful of stocks. Now, this is not new news. If you have opened up the Wall Street Journal recently, or you have read about what's going on in markets, the Mag 7 is not new news. Now, the amount that is being invested in AI, though, and the CapEx, so the capital expenditures that are being spent on building these large language models. Maybe you've picked up a newspaper and you saw that Meta tried to spend a signing bonus of over $100 million for an AI engineer. By the way, if you're on the line and you are that individual, good for you. That's a great 2025 coming your way. So a ton of money is coming in and being spent in these companies, and it's starting to disproportionately be measured relative to things like revenue, like earnings or free cash flow, just the money that's coming into a business and the money that's going out of a business. And you can see that has, even though spending on AI is not new, the magnitude of spending on AI as of late is new, right? It's driving down free cash flow of these businesses. And it's not being caught up on the other end. They're not receiving inbound cash flow through revenue or through earnings that is offsetting that spend. So investors are making a big bet here that the AI craze will continue. And this will be an important part of our discussion in 2026, right? Just understanding the dynamics of this. And it's obviously something that we spent time on this year. We have diversified portfolios that help mitigate this risk. It's through the ownership of small caps, which Rob just talked about. It's through the ownership of international securities, which we talked about not as much today, but pretty extensively coming into the year because we had an overweight to those. And it's through non-equity securities, just owning fixed income or other assets that just don't look like the Mag 7. So a lot going on in this space. It's going to be an important and central key to 2026 and beyond. Now, speaking of fixed income, again, a couple of things that we would draw out just ahead of questions as we have a few minutes left here. Overall, the fixed income market still looks fairly attractive. The way to read this chart is the higher the number or the closer it is to the top of its column, the more attractive it is relative to history. So if you're all the way at the top, it's as attractive as it looked over the last 20 years. And so as you look across various cohorts, cash, short-term bonds, long-term bonds, the ag, which is just consider that the S&P 500 of fixed income. and municipal bonds, right? It's an attractive environment. Now, fixed income doesn't come without risk, and there have been a number of interesting headlines, we would call them, as of late around defaults. Now, part of that risk that we would point to is the fact that the spread for fixed income that is not a government security, so basically the additional yield that you earn for taking on default risk, is very tight today. It's about as tight as it's ever been or in the last 20 years for investment grade. And it for non-investment grade, so more risky debt, also about as tight as it's been. And we talked about this coming into 2025. If you're not being compensated for the risk of default, right? The risk that if you put $100 in that you get $100 back, if you're not being compensated that's that spread, then you should minimize that exposure. There have been some defaults as of late. You might have seen them in the news. First Brands has come up recently. That's an automotive derivative. Tricolor, which is another, actually, coincidentally, automotive. Some of that could be tariff related. Some of it, we'll see where it shakes, could be fraud related. But those defaults, right, we're starting to see a few of those sneak into not to our portfolios, but in the market. And that is a risk that we need to be aware of. So both of these kind of final two slides and food for thought of areas of caution. High concentration as we see it in the large cap space. We should think, and we do think collectively and thoughtfully about how to mitigate that risk. And then today, we think the spread in fixed income to take on additional credit risk. And usually when markets are up, people feel like a willingness to take on additional risk. We just don't think we're being compensated for that today. So 2 quick words of caution and maybe a little bit of a tie into our 2026 outlook. So with that, in a handful of minutes, why don't we take any questions that we didn't address? I know some came in through the queue already, and we hopefully addressed them along the way. Rob, do you see any in queue that we need to hit, or are we going to give people just a couple minutes back?
We had one that just came in related to the spread discussion that you were talking about, Brad, and it's is the spread tight because of a greater perceived risk in treasuries, and is that being reflective in the corporate default risk as well? Maybe I can grab it and you can chime in as needed, but a lot of the spread compression has been for a couple of things. Technical factors, right? So a huge amount of demand into the credit space is driving the bulk of it, and there's been a pretty low issuance, and all the issuance has been oversubscribed. So huge amounts of demand from pensions, insurance companies, and overseas buyers as well, really driving that credit spread down. And fundamentals have been strong too. So on the investment grade side, fundamentals remain attractive. Probably a little bit lower default risk on the investment grade side than obviously high yield, but I'd say it's been more of a technical driver driving spreads lower than kind of the default risk over the perceived increase of treasury risk.
Fair enough. I know we are just under noon Central here, or 1 Eastern. We want to be cognizant of time and appreciate everyone dialing in. If you have questions that were generated from this or that we didn't get to, please feel free to reach out either to your advisor or directly to us. We're always happy to answer them. Thank you as always for your support and joining the call. We will be back to you in December with our written 2026 outlook, and early in January for a oral presentation of that outlook. We look forward to sharing our thoughts of how portfolios should evolve and opportunities in markets. So until then, appreciate your support, and thank you so much for joining. See you, everyone.